Hello and welcome back to the Canadian Money Roadmap Podcast. I'm your host, Evan Neufeld. Today, I'm excited to welcome my special guest, Andrea Hansen, who's the president of Sutton Benefits and Pension right here in Saskatoon. So our conversation will help you better understand your current benefits and what to be looking for if you're changing jobs. All right, Andrea, thanks so much for joining me today.
Thanks for having me, Evan.
We're going to take a few different directions probably in this conversation here, but for anyone that's maybe currently looking for a new job or someone that recently changed jobs, or if you don't have a good handle on how your benefits at work actually work, that's probably everybody. I realize that's a pretty wide scope here, but this would be a good episode for you. So when you're looking at, say, a job posting, you often see, sometimes they'll include compensation in there, like you're this much an hour, whatever, but almost always you're seeing something like comprehensive benefits or something like that, which the term benefits, that's got to be a loaded term, right? So what do you think about when you see things like that on a job posting?
Yeah, well, first, great that they're offering that. It's a good sign if they're including that in their compensation package. But I think maybe people underestimate the total value of that additional compensation, not understanding the dollars behind it or the percentage of an employee's potential total compensation that the benefits and, maybe a matching workplace savings program make up. So yeah, when there's an ad that says comprehensive benefits, that's pretty vague. And I've seen everything from very basic, health spending accounts or basic health and dental coverage to, as comprehensive of a plan as you can get. So definitely if I was interviewing with an employer, I would be prepared with lots of questions, ask to see a summary of the benefits program, their pension program, the health spending account, wanting to see that their whole strategy behind their total rewards program. And ask a lot of questions. Okay,
so maybe we'll get to some of those questions that we should be asking there. Because comprehensive, putting that in there, they might be underselling it or they might be overselling it.
That's right.
Right?
That's
and
right.
You probably see all kinds. So in your mind, maybe what are some of the key things that you should be looking for? Because benefits and pension comprises both things like retirement savings, but also things to do with your health and insurance. Like this is a pretty wide spectrum of part of your compensation. So what are some of the key things that you might be looking for or questions that you should be asking when looking for a new job or to better understand your own program?
Yeah, for sure. I think, maybe most people think immediately of expenses that are coming out of their pocket today. So it might be initially very attractive to tell me more about the level of coverage for health and dental benefits and, what is the percentage reimbursement or how much is the maximums for massage therapy and chiropractor and orthodontics and vision. Like it's all those things I think initially what people are thinking about because that's coming out of their pocket right now. But, other big component of a benefits program is the life insurance component and the income replacement or disability insurance. So short-term disability, long-term disability, critical illness coverage, there's all of that coverage that has a tremendous amount of value. You're protecting your ability to earn an income, which is a huge asset. If you think of someone who's 30 years old and, earning $100,000 a year and their career ahead of them, that is a very big asset. And if there's no income replacement or disability insurance benefits as part of the package, then that individual is looking to having to get that insurance on their own, and they're likely going to pay a lot more than what they would with their benefits. And they have to medically qualify for any insurance that they purchase personally. So again, one of these big advantages of the value of being part of a truly comprehensive benefits program is, you don't have to medically qualify. You're getting access to benefits at a cost that you wouldn't be able to do on your own.
Okay, so maybe let's start with some of the options on the retirement savings side of things. What are some options there? I know people have likely heard of RSPs or just pensions in general, and faithful listeners of the podcast will know there's a couple different types of pensions there.
That's right.
But there's also things like DPSPs, and we don't need more acronyms in our
No, we don't.
in our industry here. But what are some common ones, and what could you be looking out for in that case?
Yeah, definitely. I think if you put it on a spectrum of plans that have the most maybe flexibility or less rules, you have your group RSP on one end of the spectrum, and then on the other end would be your, registered pension plan. And so it's just the differences in them is how accessible the funds are, whether they're geared and locked in for a person's retirement, or if there's opportunities for the employees to access those savings. But then, a big key point is finding out, what is the matching percentage, how long of a waiting period there is before you can join the program, if there's options to increase your percentage over and above the matching percentage. Just, finding out more details.
Gotcha. And so there's maybe I'll just have my own opinion here. I don't think there's like a good amount or a bad amount that you could be looking for necessarily, because, even if it's say 1% matching, it's like, well, you still get 1% of your salary.
That's right.
Like paid for by
give yourself an instant raise.
Yeah, exactly.
By participating.
But I have seen matching RSPs as high as 9%. So essentially, because you get 18% of your income, you get all of your RSPs maxed out on your behalf before you even get paid or before it hits your bank account.
That's right.
Right.
Yeah.
Do you see any numbers that are normal, quote unquote normal? I'm doing air quotes here.
Yeah, I think so. And again,
or
normal,
typical,
more
maybe
typical.
Yeah,
I would say the type of clients that we work with, I would see a common one being a matching 5%.
Okay.
So if employer and employees both contributing to the full amount, then they're saving 10% of their gross income, which is a good start to, the saving for retirement. So we also see employers that will do an increasing amount based on years of service. If that's part of their total reward strategy, is wanting to reward employees that stay with them longer. So we definitely see that, where maybe it's a certain percentage based on less than 5 years of service, and then it grows higher and higher to have those kind of additional carrots along the way. So, but I would say 5. And, if we are talking from the employer's perspective, when looking at starting a program like a workplace savings program, that's where we advise them to be competitive. This is where you want to be.
Okay. So now on the pension side of things, defined benefit pensions, these are kind of like the white whale of the retirement savings industry now, right? Like there's very few of them. How often do you see a defined benefit pension plan anymore?
Yeah, not
outside of nurses and teachers.
That's
and whatever,
right. Not with the clients that we work with.
Yep.
Because we're dealing with private companies, nonprofit organizations. Don't see them.
Okay, well, that's an interesting point that you made there, though, because if you're looking for a new job, that doesn't mean you have to be in a huge corporation to get benefits like this.
Absolutely not.
There's local businesses that'll offer great benefits. Including nonprofits in some cases.
Including nonprofits. Yeah. And, speaking of nonprofits, we actually will often see their benefits because maybe on the compensation, the base compensation, they don't have as big of a range to be able to pay very high salaries, so they can make up for it. And I find, and then depending on their own mission values, they can be very generous programs actually with nonprofits.
Oh, interesting.
So don't rule the certain industries out, and small employers as well. And, they have access, even more now. I think people, just as an example, they would think health spending accounts are something just big corporations offer. And there's lots of small businesses that offer it and have lots of flexibility around it. So I wouldn't judge by the size of the employer.
Totally. Oh, okay. That's a good thing to keep in mind. Yeah, because you'd think that the bigger the name, the bigger the the paycheck and everything else. And
Maybe.
Maybe, yeah,
Maybe.
but maybe not. Yeah. Okay, very cool.
Yep.
Okay, so those are some of the ways to save, but I bet you probably see lots of employees not maximizing how much they take advantage of these programs. Is that common? Like, say there's a 5% match. Do you see people just say, no, thanks, not for me? Or what do you see on your end?
It definitely depends on who their advisors or their partners are and how engaged they are, and employer willing to spend the time educating their employees about what the offerings are. So
I'll say this before I get into I got into the industry when I was working a part-time job while I was in university. It was at a group home, and there's like, there's this other thing, but your money's locked up for a while. And I'm like, well, I need access to that. But like, I had no clue what it was.
Exactly.
I just turned down 3 or 5% free money,
without
or
knowing.
free, air quotes again here, but like I didn't understand how it worked, and I didn't ask the question, so I missed out. So I assume there's other people out there that are in the same boat. Yeah,
for sure. I'm sure that happens, and which is that education piece is just so important, and who those partners and advisors are, and supporting the HR team and whoever is actually sitting with employees and onboarding them onto their benefits and their pension program. And, as an example, a lot of, group retirement savings plans are set up as, optional or voluntary. Mandatory is not as common, although there is a trend going that way.
In the U.S., it's much more common now.
Yeah, and we're seeing that here as well, where employers, I think, are looking at those programs differently and seeing, the value of not just helping people save for their retirement, but what that does for the employee's level of financial stress and their own feelings of security, and seeing a career with that employer. Like, there's lots of good reasons to make it mandatory, but the plans where they are optional, then if the person onboarding them is like, oh, you don't have to, like, you don't need to if you don't want to, right? And not, like you said, giving the full information of why it would be a benefit to them.
Right.
Yeah.
So if you're listening to this, take a look at what your program is, and you might be leaving money on the table. So ask the question.
Ask the question.
Talk to your HR person. If you have a group advisor that comes around, talk to them. But yeah, just have a look at your total benefits and make sure that you're maximizing those matching programs.
Yeah. And speaking of maximizing, that's another thing we often see, whereas if employees are leaving one employer to another, and they're leaving behind small amounts of money that they've contributed from past workplaces, they can bring those, oftentimes they can amalgamate those into their current employer's plan, and can be advantages to doing that as well.
Simplicity being a big one. Yeah. And you see it all the time too, like where people have little dribs and drabs all over the place, and honestly transferring it. The advisor that's in charge of managing your group plan, they'll help you out with the paperwork.
That's right.
We see it all the time. So
that's right. Yeah, absolutely. And one other just side note, I was thinking about from, an employee's perspective when they are assessing a new opportunity, and the waiting periods, right, is one where often there might be, a 3 months waiting period before the benefits plan kicks in. The retirement savings, it could be 3, 6, 1 year and longer. And that's something that's negotiable. It's not, the employer can waive the waiting period. And if I was an employee and I was leaving a great job that had disability insurance and life insurance, and I wouldn't want to go 3 months without that coverage. And I think, again, people think back to the health and dental, and they go, oh yeah, I can wait 3 months. I just won't go to the dentist. But it's those other ones that you're putting yourself at a unnecessary risk. And I wouldn't want to be 3 months without that coverage.
For sure. I had someone tell me relatively recently that they didn't plan on getting disabled. I'm like, oh,
Nobody does.
Yeah, that's kind of the point.
That's kind of the point.
Yeah.
Yes.
So yeah, totally. You want to make sure you understand what those waiting periods are, and be careful when switching. So you understand.
Switching, and this hasn't happened often, but we have had that experience where employees might not know when you're joining a new benefits plan. There's often, almost always, a pre-existing condition clause in the long-term disability benefits. And so if they have health history, past health condition, and they leave that employer where they've already satisfied that pre-existing condition clause, that doesn't transfer over. So it starts when they start with their new job, when they're on the benefits, and they're often a 1-year pre-existing condition clause. And we've seen that come into play.
Wow. Okay. Maybe we're getting into the weeds too far
Maybe.
here. No,
But
I want to keep going, because what would be something that could be considered a pre-existing condition in many cases there?
Yeah, if somebody is, currently being treated for a medical condition, so that could be, any type of prescription drugs or seeing a doctor. If they're currently being treated for a medical condition and they can't go treatment free for 90 days, this is a very typical one. Can't go 90 days without treatment, then you have to be insured for 1 full year before you're covered for anything pre-existing.
Oh, wow. Okay. So that could be something pretty benign, like relatively.
Yeah. I've only seen it a couple times in our, 20 years, but it's something that I don't think, an employee might factor in when leaving an employer.
Gotcha. Okay. So maybe let's talk about those health benefits a little bit more. So you mentioned something like health spending accounts and the dental and eye care and disability insurance and life insurance.
Right.
And it's like, what's a health spending account? Maybe let's start there. Like, how does that work?
Yeah. We're seeing it more common. I wouldn't say it's common, but more common to complement a benefits program with a health spending account and a wellness account or flex account. So
would they be separate, or is that just different terms for the same thing?
They are. The platform is integrated, but they are separate in terms of how they're treated tax-wise. So if it's a health spending account, only things that qualify under medical expense tax credit with Revenue Canada, those are non-taxable benefits to the employees. So they can use it to top up anything not covered under their health and dental benefits. And that could be anything from, the 20% that's out of pocket for prescription drug coverage, or if they've hit their maximum on massage therapy, they have excess, anything not covered. It's like a top up to their health and dental. When you get into flex or wellness accounts, then the employer is deciding, a list of eligible wellness related items that they support in their organization and what they want to provide that extra financial resources for their employees. And it's a taxable benefit.
Gym membership.
That's right.
Running shoes.
Yes. Yeah. Fitness. I think that's where they traditionally started, but we now see employers being very creative in their wellness offerings. We've had clients that have expanded for pet expenses, right? As a great one. If you have a lot of, maybe single people, and we've seen that where their expenses on health and dental aren't high, but they have pets. So you can offer, a wellness expense for all their pets. I've seen clients do like yard maintenance equipment. So anything outdoor gardening, because if that is if it's kids sports fees, child like daycare subsidy, it's just like, if you just think of wellness in that holistic way, is like anything that you can do to help support your employees feel better and be happier, they're going to be more productive and better at their work. So yeah. And that's what I love about, our clients that, are more creative in what they offer, and beyond the traditional benefits and pension programs.
Oh, that's very cool.
Yeah.
And so you're seeing that more often now, in addition to, as opposed to?
No, in addition to.
Okay.
Yeah, in addition to.
Okay, so on the health and dental side of things, are there typical ranges here, or like what does a deluxe package look like versus something really simple?
Yeah, there is.
Coming from a guy with glasses and 2 kids and all that kind of stuff.
Yeah, it adds up, doesn't it? Yeah, there's definitely a big range in reimbursement levels. So whether it's, 80%, 90, 100% reimbursement on different benefits, and then the maximums. That's one that maybe people don't look at immediately, but we've seen prescription drug plans with $1,000 maximum per person per year to unlimited. And there are some very expensive prescription drugs that an employee could, or their family members could be taking. So yeah, big range in maximums and reimbursement levels.
So for someone that currently has glasses and needs to get a new, prescription every year and whatnot like that, maybe take a look at the optical section of that one, which that could be different from one plan to the next, maybe, right? So
it could be vision, as an example. There isn't a huge range.
Okay, I didn't do my research before this. I was just
totally good.
Giving a terrible example.
No, it leads to a great segue because it's I don't see a big range in vision in maximums, but this is where the health spending accounts are such a great complement.
Okay.
Right? Because an employer is looking at, expanding their benefits program and including vision, but not everybody wears glasses.
Right.
So it's of value to those families that do, whereas topping it up with health spending account, if you need additional vision coverage, you can access it there. You don't have kids, you don't care about orthodontics, right? Now there's your health spending account.
So that's kind of the health spending account, the health and dental side. What about the insurance side of things? We kind of briefly talked about disability. I've talked about disability on the podcast before, but between disability and life insurance, life insurance is terrible branding. It's too light. It should be called death insurance, but it doesn't, right? And so that one is much more grim, unfortunately. But disability is about your ability to earn an income.
That's right.
Doing the job that you're hired
Getting paid to do.
Exactly. So how does disability insurance work? Typically through a comprehensive benefits package.
Well, there are short-term disability and long-term disability.
Okay.
And so there can be a range in that as well. Not all employers have short-term disability. So when it's short-term disability, it begins on the first day if an employee is not able to work because of an accident or they're hospitalized. If it's because of an illness, there's usually a 7-day waiting period before the illness benefits kick in. And then short-term is a weekly income replacement for the employee. And if they don't have short-term, and they're not able to work, their only option is employment insurance. But it's only 55% of your income, and it's a taxable benefit. And the maximum insurable earnings, it goes up each year, but I think it's around 60,000. So if you are a higher income earner, relying on EI is
maybe half of your income.
Half of your income. Yeah. So short-term disability would be a benefit you'd want to ask if it's included in the package. And then short-term then leads into long-term disability. Long-term disability is a monthly income replacement and could potentially be till age 65.
Do you often see it going to 65, or what are some of the common duration periods
for long-term?
Yeah.
Great question,
it's all
Evan.
over the place.
Yeah, it is all over the place with group insurance. I always say, disability insurance with group benefits, it's meant to cover the masses. And so there are usually with group disability, after they insure your own occupation for the first 2 years, And then after you've been on long-term disability for 2 years, the claim will be reassessed, and the insurance companies will look at, you can't do your previous occupation, but is there another, gainful employment that you could do based on your background and training and experience? Is there something else that you could do and earn income from? And if they deem that you're fit and able, then your claim could potentially end. Otherwise, if you're not able to be gainfully employed, then you could be on disability till age 65. So yeah, it really depends on the permanence of the disability.
Right. Okay. So there's a lot of definitions that go in there. So that you talked about the own occupation versus any occupation.
Yes.
And then at that point, sometimes they would provide access to training programs to
That's
get you back
There's
to work.
Rehabilitation. Yes.
Yeah.
Yes.
Like, the insurance company, perhaps selfishly, doesn't want you to be on claim forever.
They're going to help you get back to work.
Yeah.
Yes.
And I suspect you, as the worker, don't want to be on disability forever either. Maybe for those of you that are thinking, oh, why don't I just get my own disability policy too? And I can make more money if I'm disabled. It's like, well, you can't really do that. There's rules around having too much disability coverage too. So if you have a good policy at work, you might not even be able to buy your own policy in addition to that, right?
Yeah.
Yeah.
Yeah. And you reminded me of something else, Evan, when you were talking at the beginning about, what questions to ask when you're participating in a benefits plan. Usually employees are paying a portion of their benefits. It's not common to have the employer paying 100% of the premiums. And often you'll hear, the employer pays half and you pay half. And employees don't sometimes realize that their half is usually funding their disability benefits and their life insurance benefits. So as long as they're paying 100% of the premiums on those benefits, it's non-taxable benefit to them at time of claim. So it's in the employee's best interest too that their premiums are going towards their disability benefits.
Gotcha.
Yes.
Okay. So this is almost like, it's kind of like the matching component for the other benefits as well. So it's not like, everything that we're talking about here is just free and it's flowing to you. Those are good questions to ask.
They're
it's like,
great
okay, it's like,
to
this looks like a great benefits package,
Yes.
but how much am I paying for?
Yes.
Yeah.
And that leads into, often the health and dental plans, you can waive the coverage for health and dental if your spouse has a comparable benefits plan. So sometimes employees will go, they're quick to waive their coverage because I'm good. My spouse has a great benefits plan, not realizing that the part that they pay isn't going to change that much because their half has to fund the disability and the life insurance. So they're waiving, but they're giving up the portion that the employer is paying. And if they take the coverage and coordinate it with their plan and their spouse's plan, the maximums double, like they work together. They have to be, careful to assess your own situation. And again, ask those questions. What's the cost share? What benefits am I paying for? What's the employer paying for? And not being quick to waive the health and dental benefits.
So how does that work? Or could you explain a little bit more? So say my wife has great benefits and then I get a new job and I've got something else that looks equally great. How do I make a claim there? Like what the insurance company will probably say, do you already have this or do you already have that? Or how does that work?
Yes. What is
There's
nice
infinite possibilities, I'm sure.
There is infinite possibilities, but the rules are set for all of the insurance companies are benefit providers. So it with coordination of benefits, it basically works that your employer is your primary. So your claims go through your plan first. So your claims will go through your employer, your spouse's claims would go through their employer, and then anything not covered on each other, then you can go to each other's plan to get the rest back. And then with dependent children, it's just whichever parent is born first in the year. So it's not based on age. Yeah, it's just if Evan, you're born in January and your wife is born in April, kids claims you're the primary insurer. Kids claims goes through your plan first. Anything not covered then goes to your spouses. So every carrier uses the same rule.
Interesting.
Yeah. And if you're born on the same day, because that can happen, then it goes to your first name and the letter in the alphabet.
No, it doesn't.
Yes, it does.
Really?
And why I remember these things, I don't know, but there's a fun fact for you.
I have a couple clients that are born on the same day, but they're self-employed. Yeah, anyways, that's a different conversation.
It happens.
Yeah.
It happens.
Wow.
Yeah. Yeah. So it's not, and two, as an example, I'm looking at people with families and orthodontic coverage. There's very few plans that, well, the most common would be 50% reimbursement for orthodontic coverage, might have a $2,000 lifetime maximum. So if anybody's put their kids through Invisalign or braces, you know that $2,000 doesn't cover the whole cost. Yes. Yeah. So that coordination of benefits can really help.
Gotcha. Yeah, the $1 million smile, right?
That's right.
Yeah, exactly. Okay, and then we haven't really talked about life insurance. As far as group benefits, like in owning your own insurance, it can be, there's tons of different products and whatnot, but what's typical with life insurance in group benefits?
In group benefits? Yeah, definitely group benefits are not meant to cover all of a person's life insurance needs. Sometimes, though, that may be the only life insurance that they have. So with group plans, it's typically a multiple of earnings. So you might have life insurance coverage or 1 times or 2 times your annual earnings, or a flat amount. So probably multiple of earnings would be more common, or a flat amount of coverage. And the flat amount might be 50, 100,000. Like, it's not going to be a significant amount. And then there's optional life insurance that employees can access. So if they wanted to apply for additional insurance through their plan, they could, and they do have to medically qualify for that extra insurance. That's a good option to look at. And that applies to the disability coverage as well, because sometimes there will be a limit. They call it a non-evidence maximum. There'll be a limit to how much disability coverage an employee can get without providing additional medical information.
Regardless of their salary.
Yes, regardless of their salary. So that's something, definitely to pay attention to, because it might say, there's disability coverage and the monthly maximum is $10,000. And you're like, I'm good. Covers my income. And then the non-evidence maximum is $2,500. And you might not know what that means. And so it's, again, finding out what coverage you're eligible for. Is there additional you can apply for? And make sure you get the most that you can.
Okay, so for someone that, we were talking about pre-existing conditions and medical evidence and all this kind of stuff, sometimes it's really simple things that keeps people from being able to get certain types of insurance, like even things like diabetes. Like, we all know people with diabetes and whatnot. It could be hard, or Crohn's, like that's a really common one, unfortunately. So if you have one of those health conditions that makes it tough to provide medical evidence to get additional coverage, things like life insurance at work could be really valuable.
Very valuable. Yeah. Extremely valuable. Yeah, if there's people that are not insurable.
Right.
Yeah, and the only access to coverage would be the guaranteed benefits that would be offered through your employer. And an additional benefit or perk is, once you're on a group plan, and if you leave that employer, you can convert your life insurance, so that if you apply for conversion within 31 days of leaving your employer, there's guaranteed options to continue that level of insurance. It's going to cost a lot more than what it did through the group plan, but for someone that doesn't have any other insurance, that's a great opportunity to be able to convert it.
Gotcha. Okay, so when you say convert it, let's just, for simplicity purposes, that's essentially converting it from a group plan to a personally owned plan?
That's right, Evan. Okay. Yes.
Perfect.
Yes. Yep.
Nice. So people that are listening here, maybe thinking about leaving, already left, or will retire someday. So amongst all of these things, what can you keep when you leave under any circumstance? Like, I won't delve into getting fired for cause or anything
No.
like that, but you have options generally with both the retirement savings, with some of the insurance plans. So maybe let's start with the retirement savings. Say you leave or you retire. What are your options there?
Yeah. If you leave or retire, and if that money is vested with you, and then that's your retirement savings. And that's where, you would want to talk to an expert in what your options are. If you are, transferring it into your own personal RSPs, or just it really just depends on what the employer's structure and setup of the plan were. But those funds are yours.
Perfect.
Yes, those funds are yours. Yes.
Yeah. And in some cases, if you don't work with an advisor, you're not a DIY advisor, can you keep it with the plan there?
You can. You can. That we see lots, of former, that they've left and they've just kept those assets there. Yeah.
But then the opposite, you don't have to.
You don't
Right?
have to. No. And I mentioned that vesting. So that's, back to your point earlier about, a DPSP or deferred profit sharing plan. If that's the structure of a program that the employer has in place, they might have, you have to be employed and contributing to the plan for, say, 2 years before the employer's contributions vest with you, and meaning you own it. So if an employee leaves before that 2-year period, they'd only be able to take the portion that they've contributed into the plan.
Gotcha.
Yes.
Okay. Which would be a portion of it too, right? So it's not
whatever
like you have. So if your contributions or the employer's contributions haven't vested, it's not like you have to give up the part that you put
That's
into
right.
it.
That's yours.
Exactly.
Yeah. Anything you've contributed is yours. But that's something to think about. If
there's real money there.
Employer's contributions, if you've reached that vesting period. Yeah. But health and dental you can convert it. So as long as you convert it within 60 days of your retirement or termination, there's lots of good options for converting your health and dental benefits without having to medically qualify. And same thing, you're leaving the group plan. It's not the same level of coverage that you had before. There's just conversion products with range of coverage. So then you choose which product and options that you want, and then you pay those premiums personally.
Gotcha. So say you were a self-employed person and you never had that, and you're just paying out of pocket for everything your whole career. By the time you retire and you want to travel and whatnot, and maybe you have one of these pre-existing conditions, maybe you can't even get it at all. But if you were with an employer that had a great group plan, and you could be in the same relatively poor health or whatever, you could convert a portion of it under certain circumstances.
And as long as you keep paying premiums, once you have that personal product, you can retain that.
So if you have these plans at work, that's really valuable.
It's very valuable, very valuable.
For sure. Yeah.
When you look at the, in terms of total compensation, like those additional benefits, can be, 10 to 20, 25% of additional compensation. Like it's a significant amount.
Wow. That's great. Okay. Same thing with life insurance, disability. We talked about those ones. You wouldn't be converting a disability policy because you're not working anymore.
Yeah, that's very rare. Yeah,
exactly.
That's very rare to be able to convert it. There is some contracts, but it's very uncommon.
Right.
Yeah,
Gotcha.
to be able to convert it. Yeah.
Okay.
Yeah. And I was going to say, I just think it's for an employee looking for a new opportunity. Again, this is the business that I'm in, but it communicates a lot about that employer, about what they are investing in with all these other benefits. Like it just says a lot about how they care for their employees and their families, how they want to protect them, the coverage that they want to provide to them, thinking about their, future retirement and financial security. And so going to an employer that doesn't have that, to me, it just communicates a lot about the employer.
So even if the salary is comparable or even slightly higher, there might be some questions to be asked, perhaps. Unfortunately, I ran into this recently with a client who had a great paying job, and he previously had a great RSP matching program and everything like that. And one reason or another, I think the company got bought out, and so he decided to leave, and he went somewhere similar, was doing the same job, making a very similar salary, but they didn't have any of the similar benefits. That was maybe a red flag for the level of compensation, the level of skill required for that position. But we only know that in hindsight now, and he would say this too.
For sure.
But then there was other things that kind of happened. It's like, oh, can you wait till Saturday for me to pay you? Like, oh, okay, whatever, and so on and so forth. And he has since found another job, and he prioritized looking at the benefits again.
Yeah.
And it's, there's certain things that you can be looking for in that way too. So so like, why an employer would offer these things in the first place is because they want good people to work for them, right?
They want good people, and they want healthy people as well. So I just think of an employee in a very physical job, like in a manufacturing facility and on the shop floor and using their bodies all day long and standing on concrete, and what support do you want to provide them? And so, physio, chiro, massage, like those additional benefits, because if there's not that financial support, they may not be inclined to spend, their disposable income on keeping their bodies healthy. Right. So it's good for business. It's good for business. It's like as simple as eye exam coverage, and all of us who are at computers all day long, I want to make sure it's not a financial decision whether or not my employees get their eyes checked and make sure they're wearing proper eyewear.
Right.
So that leads to headaches and migraines, and then they're not
at work.
They're not as great as they could be at work. So keeping healthy and then that whole like mental health support and financial stress and giving access to your team to help with the everyday stressors. You want to do that.
Yeah. Okay. Anything else that you'd like to say? That was probably a pretty decent way to wrap it up there. But if there's anything left on your note sheet there of things that you wanted to make sure we covered.
Well, you asked great questions, Evan. and I think hopefully the big takeaway is just to make sure you ask more details, ask for a summary of these different benefits, and even asking the employer what is their philosophy on total rewards. Like, what's a priority? Ask them, why do you invest? Why are you investing in benefits and pension and, a health and wellness plan? Why do you provide that? Because you'll get
from the horse's mouth. Right? Yeah.
Yeah. I think I maybe that's the best question is why are you investing in this in the first place?
You might not, if a company doesn't offer it, you might not want to ask why they don't, because you might not want to hear the answer. Maybe.
No, I think I would want to hear the answer.
Or you might not want to work there in the first place.
That's right. I would want to know why.
Yeah, but you might not want to work there. Yeah. Cool. Well, thanks so much for joining me, Andrea. This was great.
Yeah. Thanks, Evan.
Thanks for listening to this episode of the Canadian Money Roadmap Podcast. Any rates of return or investments discussed are historical or hypothetical and are intended to be used for educational purposes only. You should always consult with your financial, legal, and tax advisors before making changes to your financial plan. Evan Neufeld is a certified financial planner and registered investment fund advisor. Mutual funds and ETFs are provided by Sterling Mutuals, Inc.